Stocks versus real estate. I'm going to tell you why real estate is a way better investment. Okay, let's assume you start with a $200,000 initial investment, and every year you contribute to your portfolio by $25,000. You keep adding to it. That's how you should be investing into the stock market anyway. So assuming you have a 7% annual compounding rate, and so that's $200,000 at the end of the year, $14,000 increase at 7%. You contribute $25,000, again you compound by 7%. So contribute, compound, you'll be left with $713,000 at the end of the 10 years, which is pretty damn awesome, right? But of the $713,000 you're going to walk away with after 10 years, you don't get to keep all that because you got to deduct your initial $200,000 investment plus the $295,000 you've increased over the past 10 years, so another $250,000. You'll be left with $288,000. But if you divide $288,000 by the $200,000 in your initial investment, you're looking at an ROI of 144% over 10 years, or 14% year over year. It's still pretty damn good. But here is where it starts getting interesting. If you put that same $200,000 as a down payment on $1 million property in Toronto, let's just say, and you have an $800,000 mortgage. You know, the interest rate is pretty high right now, 5%, but you know, we're going to pay it off in 25 years, so that'll be okay. Your payments will be pretty high, $4,700 a month. So don't forget, you got to deduct your property taxes and your monthly maintenance fees. And then, you know, if you're in a condo, that is, but if you're in a house, then you might have some property management, you might have vacancies, you might have repairs and maintenance anyway. And then, of course, you're only going to get $3,800 a month in rental income. And I can show you plenty of examples of that for $1 million property. So you might think that your monthly cash flow is negative $2,300 a month, $2,300 a month, or annually $28,000, which funny enough is the same as a $25,000 increase. And you might think it's a bad investment because you don't want to contribute more money into negative cash flow and you don't want to buy into it. Well, again, this is why I think you're silly, because at the end of that 10 years, your mortgage balance will be paid down from $800,000 to about $589,000. And if you assume an annual appreciation rate of 5% year over year, then you're basically looking at compounding it from $1 million property to about $1.6 million at the end of the 10 years. And of course, you don't get to keep it all because you have negative cash flow and you have your initial investment. So you subtract all that and you're left with $558,000, which if you divide the two, 558 by 200,000 invested, you're looking at an ROI of 297%. So you're looking at almost 30% ROI year over year. So you tell me which is the better investment. If you want to learn more, follow for more.